You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. The futures markets can be downright scary. Limit up, limit down. What the heck is RBOB anyway? Are they going to dump a truckload of soybeans on your front lawn if you click the wrong button? Come to think of it, maybe you should just stick to your comfort zone. Or you can break out of it with the Futures Rundown. The Futures Rundown is here to help you make sense of these scary markets. We'll analyze all the top futures trading activity, explore the ins and outs of your favorite products, explain exactly how futures work, and hear from leading experts in the futures markets. We'll even tackle all of your wildest futures trading questions. If it involves futures, then you'll hear about it on the Futures Rundown. The Futures Rundown is brought to you by T4 Futures and Options. Elevate your trading experience with the T4 Futures and Options trading platform. Whether you prefer desktop or mobile applications, T4 delivers low latency and professional-grade functionality for both traders and brokers. Take advantage of theoretical sheets, strategy solver, MBO, advanced charts, and a suite of powerful features to enhance your trading strategy. Visit ctsfutures.com or search for T4 Futures and Options on Google to register and get a free month. And now, it's time to break into the futures markets. It's time for the Futures Rundown.
All right, everybody. That music means we are back. Time to roll out the Futures Rundown here on Wednesday. I hope you're having a good week. Strap in. It's a wild one. We got a lot of course, when aren't they wild ones these days? So it should be a fun show. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the network upon which all of you folks are binging. Speaking of the network, new addition to the network, all you folks who like futures might want to check this one out. We did the inaugural episode of the European Market Brief. You could listen to it right now, wherever you're listening to this fine program. If you're subscribed to the full network, it probably is going live as we speak. You can get it in your ear holes there. Of course, we did record it live for a select few people. You had to register ahead of time. So check that one out. It will be going up to our YouTube channel. Post haste might be there already as we speak as well. So if you ever wanted a little bit of a glimpse inside the studio, which I know a lot of you have been asking for these past 18 plus years, a little bit of a glimpse. It's still a work in progress, listeners. We're still evolving here, but you know, it's kind of fun to have a little bit of a glimpse behind the scenes, and probably more to come. In fact, I may have just done a video version of Options Bootcamp with our buddy Mr. Passarelli. So maybe look forward to that hitting the network, and some more select video nuggets coming out over time, as well as the shorts a lot of you folks have been liking as well. So make sure, if you're not following us, give us a follow over there, Options Insider on the old tubes. And of course, while you're checking things out, if you want early access to this, you want to join us in the live, everything else that we do, theoptionsinsider.com/pro. You're already getting just a mountain of content on that right now. You're getting all of my OIC stuff early, all my chats in the Southern studio, as well as all of the panel audio. We saved you a flight. We saved you the ticket there to the show. We're just nice folks. We're just generous. You get a mountain of audio coming from OIC. All the folks on the Pro are already getting a ton of that and more to come. So check it out on the Pro as we check out who's joining us this week on the show. I'm pleased to welcome back our old pal, Miss Carley Garner from Carley Trading. Carley, welcome back to the Futures Rundown. Nothing going on this week, so not much to talk about.
Thanks, Mark. Yeah, I hope we can find something to talk about. It's completely boring out there.
It's struggle. You know, it's mid-summer markets. Nothing's going on. Everyone's on the beach right now. Nothing to talk about. But nonetheless, Carley, we will soldier on right on into the trading pit.
It's time to break down all the action that's lighting up the futures markets this week. What's limit up and what's crashing and burning? Let's find out. It's time to enter the trading pit.
All right, listeners, welcome to the trading pit where we break down what's lighting up the futures markets this week. And we'll get to all the specific product fun in a second, Carley, but I have to ask you, we haven't talked to you in a month. We've seen a lot of wild movements in all the assets, in the equities and gold, in the crypto and FX and the rates, just you name it, ags, ever since your last appearance. This past week, of course, we have seen perhaps a bit of a detente, a bit of an easing in the trade war. Markets certainly liking it on the equity side on Monday. Massive 3+% rally. I'm hearing some talk, a lot of that might have been short covering now, not just straight buying, but which would make maybe a little bit more sense given just how feverish that rally was. But still, nonetheless, we are pretty much back to close to, if not flat, for the year. In the equities, vol has come crashing back to earth. So what are your thoughts, Carley, on this latest reprieve in the trade war and the massive rally we're seeing in equities and the just devastation in vol?
Well, I mean, as you kind of mentioned in the intro, normally, like on a normal year, obviously this is not a normal year, we're talking about summer doldrums. Everyone's kind of forgotten about the markets. They're traveling with their families or doing other things. I have a feeling this summer is not going to be like that. In fact, it's probably going to be the opposite. So we've had an entire bull market and bear market in 6 weeks. And this is just absurd, to be honest. So I'm trying not to have expectations other than, hope for the best, but be prepared for the worst, because I don't think this volatility is going to go away this easily. I suspect there's probably a lot of people that were kind of washed on both sides of the trade. Regardless of what side you're on, it's been such a whipsaw, probably the most historic whipsaw we've ever seen in terms of magnitude and pace. So it really rough waters out there. The good news is there are other markets to trade. Commodities aren't quite as susceptible to tariff news. I mean, some of them are. Like if you're talking about grains, they are. But the nice thing about the grain market is this is, this isn't their first rodeo. The grain markets were kind of in the middle of the trade war during Trump 1.0, and they priced a lot of the demand destruction from the trade war into corn, soybeans, wheat before we even got there. So grain markets knew what they were doing, and it's a little calmer ride over there. All I can say is less is more. That's my best advice. Less is more. Don't try to swing for the fence, because if you strike out, it's not just going to be, it's going to be pretty painful. It's not going to be something that you walk away from without some bruises.
No, these are very bruising markets out here these days. You're just getting whipsawed. You're right, on both sides of the fence out there, listeners. So a lot of fun stuff lighting up the tapes for us to get to this week. Let's go to the downside first, just to mix it up, because we got a wild one on the upside that I know a lot of people are probably going to want. I think I see our chat is already talking about it, so we'll get there in a second. First, to the downside, to the red we go. What's lighting up our screens to the red this week, listeners? Number 5, we got our old pal spring wheat, so kicking things off in the ags, off 4 2/3% right now. Number 4, listeners, this will be welcome news for all you S-Bucks fans out there. Coffee coming a little bit off its highs, off 5% this week. Still got a long way to go to get back to where it was at the beginning of the year, let alone last year, but a little bit of price ease for all you mocha frappuccino fans out there. 5% to the downside for coffee, number 4. Number 3, lithium, one of the EMs making it in this week. Lithium easing off 5.62%. It's been a generally rough year for both of the EMs, uranium and lithium. If you try to throw platinum, palladium out there, that's a different story. We'll just stick with those 2 EMs for now. Number 3, lithium, 5.62% to the downside this week. Number 4, gold. Yeah, gold bugs, cover your ears. Gold off 6.18% this week. And the big dog, yet again, that's why I told you there's some asterisks here. Vol likes to whip all over the place. Vol was the biggest gainer for the week for the pretty much every week of the past month. Now it's turning the other way. Remember I said that worm's going to turn, listeners. And there we are, S&P 500 Vol, aka the VIX, off nearly 15% just this week. Carley, anything catching your eye in our list of downside movers this week?
A couple of markets that we've been paying pretty close attention to is coffee. For you coffee drinkers out there, you might be excited to know that the odds are like this is a very seasonally bearish time of year for coffee. Normally, we get a bit of a weather rally early in the year, and then by July we're wiping all of that out plus some, and I think that's probably what we're in the process of doing. So, believe it or not, I think coffee has a chance to see the 250 area at some point this year. I know it seems impossible, but trust me, it's not. That's how coffee trades. It's a very boom or bust market, and I think we're probably starting the bust cycle. Yeah, I think we're probably getting something similar in the gold market. And I know this sounds totally crazy because it is, and it shouldn't have happened, but gold and coffee for several months, late last year and early this year, were trading as if they were the same asset. Makes no sense. They have completely different fundamentals, but for whatever reason, the algos or the funds, I'm not even sure who, were buying and selling those in lockstep as if they were literally the same asset. So I think they both roll over. I think they both go much lower. I know that's kind of an unpopular opinion, especially with gold, because the masses are very, very long. We saw record inflows into ETFs. COT reports suggest futures traders are really, really long. Sentiment readers are telling me gold sentiment is about 75% bullish, which is super lopsided. So when trades are that overcrowded, there's generally kind of this situation where all the buyers are in, and the only way to get out is obviously for them to sell. So I'm going to throw some crazy numbers out there, but I wouldn't be shocked to see gold trading into the low 2000s by the end of the year.
Whoa.
So hang on.
Gold bugs are coming for you. You make pronouncements like that, Carley. The gold bugs are coming for you. And obviously, you've been kind of bearish on gold for a little bit. Obviously, we saw it move aggressively in the other direction since the last time we chatted. So what were you thinking when we were hanging out north of 3,500? What was going through your mind, Carley?
Well, listen, I'm not going to lie. There was a couple sleepless nights in there. We had some positions on that took some heat, but luckily they started rolling back over. These are really, really wild markets. These are not your grandpa's markets. There's people have 23, 24-hour access to markets on their cell phones. And there's a lot of money sloshing around out there because of all the stimulus after COVID. I know that's 5 years ago, but trust me, it's still, all that money is still working its way through the economy. It was just a bazooka of liquidity. And so it's sloshing around out there, and it creates a lot of volatility. So there's never any easy money in trading, but in the current environment, it is very, very challenging. I mean, I talked to insiders that have been following the markets and trading for decades, and even they're telling me, hey, this stuff is really wild. So again, I'm going to say it again, less is more. Do not trade beyond your means. Don't try to get aggressive. It's better to miss a trade than to be in a trade wishing you had missed it.
That is good advice out there. Yeah, I'm looking at the levels. We haven't seen gold around the 2,000 level since pretty much late 2023. So looking for an aggressive retracement out there on the gold front. Gold bugs, send all your hate mail to decarleytrading.com or find Carley on the... it used to be, Carley, not that long ago. They were by far the most ardent of our listeners. If I ever said anything against gold, that was it. I would never hear the end of it. These days, they've been usurped. The crypto folks are out there. There's what depends what meme stock of the day is hot. There's a lot of other areas where people focus their ire and their zealotry now, but it used to be all on gold. So maybe that'll cut you a break in that sense, Carley. All right, let's
No, they'll find me. I'll get it.
All right, to the upside we go, listeners. And man, just a wild year, wild week. You know, the narrative for this year has been pretty much vol up, crude oil down, gold was up, now gold down, of course. And then, of course, ETH just getting the snot kicked out of it. Flip all that on his head this week, listeners. Number 5 to the upside this week, listeners, is our old pal WTI, crude oil, up nearly 9%. So getting a little bit of a lift from the potential for a reprieve on the trade war. Hey, maybe there will be some demand again if this trade war, if they cool their jets on that front. So crude getting a bit of a lift this week, up 9% to WTI. Number 4, another area that's been rocking and rolling of late, soybean oil, up 10.65% this week. And the number 4 spot, number 3, good old heating oil, up 11.86%. I know it sounds weird, heating oil rallying into the late spring, early summer, but that's what we got, listeners. Heating oil, number 3, up 11.86%. And then number 2, number 1, I saw our chat talking about it earlier. And so this will be welcome news maybe for that one. Maybe some of them said they missed out on it, maybe not. Carley, there's been a long-suffering contingent of our audience. They are the ETH bulls. They have been just taken to the woodshed. We saw a decent year last year. Obviously, ETH was up, but underperforming the major crypto assets last year. So there was a drumbeat even then that, you know, maybe Solana was going to take over its spot on the market share front. It was already stealing a lot of projects and a lot of interest, and Bitcoin was certainly outperforming it. Everyone thought this was going to be the year. This was going to be the year that ETH caught up, and instead, nope, just got the snot kicked out of it. Even as Bitcoin and others were rallying, ETH selling off nearly 50% year to date as of our most recent show. It was the number 1 biggest loser for all the assets that we track, listeners. So, yeah, not an envious spot to be in for the ETH bulls. But, Carley, that ends this week. ETH roaring back to the upside this week. I'll have to go look. For the major assets, it certainly is. There probably is some crazy Pink Sheets name that's up 1,000% this week. But for the major trading assets, I'm hard-pressed to find anything else that's up nearly 50% this week. But that's what we got with ETH. ETH up 44.5%. So they're tied for 2 and 1, the micro and the big futures. Our chat's lamenting they didn't buy more. Yeah, at least the stuff you got is looking a lot better this week. Carley, what are your thoughts on this list? We got some surprises in there. Crude oil resurging, soybeans, and probably the most surprising, ETH up nearly 50%, Carley.
That's a real shocker. Honestly, I don't follow Ether as closely as I do most of the other markets, but as soon as we're done here, I'm going to go pull up the chart and take a look at that. I actually was wondering if you had the decimal in the wrong spot. 44% in 5 days is amazing. Wow, that's pretty impressive. I will point out crude oil up 9% on a percentage basis. That looks pretty awesome. In reality, that's really not that's not a really big move in crude oil, just because we're at such lower valuations than we've been for a handful of years. I actually think crude oil has taken a step down on the ladder, and what I mean by that is, for 2.5 years, $65 was the place where everybody bought the dip. And OPEC worked really, really hard to keep prices above 65. But OPEC has basically pulled their put. They've decided they're going to try to get back some of the market share that they've been giving up and increase productions, or at least reduce their production cuts, I should say. And I think without that OPEC put there, I think 65 is the new ceiling. So we'll know within the next week or two. But if crude can't break above 65, I think this is just another bump in the road, and we continue to sell into rallies and see lower prices. I'm going to throw some more crazy numbers out there. If that's the case, if 65 holds, I think we're looking at low 50s, maybe even high 40s in oil.
Uh-oh. Getting out there. All sorts of fun predictions on the show this week, Carley. By the way, you know, it sounds super sexy, super impressive in ETH, and it is. Anything 50% is always good, but ETH not that long ago was north of 4,000, closing in at 4,500. It sold off to about 1,700, Carley. So now, even with that rally, we're back to about 2,600, 2,700 in ETH. So better, obviously, but still has a long way to go to get back to even where it was not that long ago. So yeah, ETH bulls at this point will take what they can get. It was looking like it might threatened to break 1,000 in the wrong direction not too long ago. So yeah, there was a big upgrade of the Pectra upgrade, I believe that certainly helped. And then also just a lot of renewed bullish sentiment across the crypto space, kind of that rising tide lifting all boats. So kind of a bit of a 1-2 punch, but you haven't had much good news for the better part of the past year, ETH Bulls. So take what you can get. Leading the gainers this week, I doff my cap to you. It's got to be a good week out there. Let's go out to our most actives for this week, listeners. Let's do a top 10 out here this week, listeners, because it's not the most banger of days out here. Number 10, kicking it off in the rates. We're going out to the 30-year listeners. 268,000 contracts on the tape. By the way, all of these, with the exception of one, and you could probably guess which one that is, listeners. All of these, with the exception of one, are the June contracts. So 30-year bond, 268 for number 10. Number 9, keeping it in the rates. It's the Ultra 10-year, 386,000 contracts on the tape. Number 8, our sole non-June. Yep, you guessed it. 3-month SOFR going out in December, as it usually likes to do. 413,000 contracts on the tape for that one. Number 7, the NASDAQ E-mini, 417,000 contracts on the tape. Number 6, back to the rates. It's the 2-year, 582,000 contracts on the tape. Number 5, keeping it in the equities. It is the S&P E-mini, 861. So quite a jump between 6 and 5, from 582 to 861. But the S&P obviously rocking and rolling. Interesting to go back and crunch these numbers for Monday and see what was going on in the E-minis and the micros. Banger day on the equity front on Monday, certainly. Number 4, the micro. Kept the micros in. You'll see why in a second. The S&P micro. Number 4, 927,000 contracts. Number 3, back to the rates. It's the 5-year note, 974 on the tape. Number 2, we're finally past 1 million. It's the NASDAQ micro. For a long time, the NASDAQ micro and the 10-year have been fighting neck and neck for what can take the top spot. 1.24 million contracts. Again, standard caveat applies. It's a micro, so take that number with a grain of salt, because the big dog, once again, back in its rightful place on the throne. The 10-year note, 1.28 million contracts on the tape. Carley, anything catching your eye in our most active list this week?
Well, because it's on the top of the list, I'll point out the 10-year note. This is a market that's gotten a lot of headlines in the last couple of months. But if you look at a monthly chart, despite all the rhetoric and the media hoopla, we have literally gone nowhere in 3 years. The yield is exactly where it was about 3 years ago. So it's a lot of noise and not much ado about nothing. I think that's eventually going to change. There's been some rumors that the market's been weaponized, like treasuries are being sold by foreign countries to kind of stick it to the administration. This is speculation and just hearsay. Who knows if that's really happening? But the reality is there's really nowhere else to go with your money. If you're looking for a risk-free asset, I wouldn't buy gold. I know, I was a little early to be bearish on gold. I'm not blind, but gold doesn't pay interest. Treasuries do. Treasuries pay 4.5%, 5%, depending on what you're looking at. So gold, you have no parachute. Treasuries, you do. And if you're looking at overseas securities, treasuries pay more for less risk, even if our government's a little over their skis when it comes to leverage and debt. So is everybody else, and they pay less interest. So I'm team 10-year note. I think that's a good place to be for investors. For traders, also, we're doing this. Our clients have been advised to buy futures and then buy put options, just in case we're dead wrong, and we do get some sort of crazy Armageddon, or Japan liquidates all their holdings, or whatever the case is, whatever the story of the day is. We have protection there just in case, but I'd rather be long that market. Eventually, people are going to realize that's not a bad place to be, especially if the stock market rally kind of runs out of steam or becomes volatile again. So we'll have to see how it goes.
We'll see how it's shaping up for the year. Obviously, big shakeups to our year-to-date trends, listeners, just given the numbers we're seeing this week. Again, these are wild markets, listeners. Just shaking up the game in the span of a couple of sessions. How many assets move 50% in a week? We're seeing that now. So buckle up, listeners. It's still wild out here. Year-to-date movers. Let's go to the upside just for fun. Mix it up. High-grade copper, number 5, listeners. Up 13.45% so far for the year. Number 4, canola oil, 15.75% upside for the year. Number 3, gold. Gold was pretty much at the top of this list for a while, obviously curtailing its highs, still lofty, but still, I think I checked right before showtime, a little bit shy of 3,200, about 3,175 or so. So obviously well off those 3,500 plus levels. If Carley's prediction comes to pass, and going to be a lot lower. But that said, gold, number 3, 18.21% for the year. Number 2, coffee. Like we said, easing back a bit this week, still up about 18.27% for the year. So neck and neck for number 2 there between gold and coffee. And number 1, I should say, now that VIX has been kicked to the curb, listeners, it is soybean oil, up nearly 28% for the year, 27.92%. Carley, anything catching your eye in that list of upside year-to-date movers, madam?
The obvious loser here is orange juice. That's an incredible story, because not only is it down 43% on the year, but if you look at what it did in December, it's down even more than that overall. Orange juice, I think, it's not a market that the vast majority of people should be participating in. It's very, very thin. But if I were forced to trade it, I'd probably start looking at the long side. I think that one's probably been battered down enough, and we're starting to get into levels that are attractive. That's my only comment. That's all I've got.
Well, you jump into the dark side for me, so I'll go there as well. But it is interesting. If you look at our year-to-date movers, Carley, upside and downside, you got a nice little balanced breakfast shaping up. You know, you got some coffee, you got some OJ, you got whey, so you got some dairy in there. All you're missing is maybe some eggs, maybe a little bit of pork bellies. You got a nice rounded breakfast, Carley. So
you do. Sorry for front running you. That was just that caught me.
That's a big chart. I can see why that caught your eye. Let's get to the dark side now, listeners. Number 5 to the dark side. We've actually have a 6 in here. You'll see why in a second. Number 5 is cash settled butter. So again, a complete breakfast to put it on. We need some toast to put it on, and then we're good to go. Butter off nearly 14% year to date, 13.82%. And then number 4, listeners, keeping it in the dairy, it's dry whey off 24.63%. So you got butter, you got whey, you got a nice little dairy combo there. All you're missing is your little bit of your fluid milk, class 3 milk, and bam, you're off to the races. Speaking of off to the races, we just talked about this one. So we have a tie for effectively third, listeners. It's the micro and the big ETH futures, just taking a huge leg up. We just talked about it, up nearly 50% this week. Obviously, that's going to cut their year-to-date losses pretty much in half. And that's exactly what happened on our last show. ETH was the number 1 loser for all of the major assets for the year, off near 50%. It was 47, 48, 49%, somewhere in that ballpark. This week, cutting that nearly in half, only in air quotes, off 25.5% for the year. But still, ETH bulls will definitely take it, listeners. And then number 2, back to the EMs. I said it's been a rough time for lithium, off 26% year to date. And as Carley alluded to, the big loser on our breakfast table this year, OJ, off 43.65%. So I guess that can balance out your losses on coffee. If you drink a lot of OJ, maybe you're flat now for the year with how much you're shelling out for that grande mocha frappuccino. But you know what? You folks are shelling out a lot of questions. Let's get to that now. A little bit of the old futures free-for-all.
Ring the bell. It's time to take on all comers in an epic Q&A battle royale. All questions can enter, but none can leave without an answer. It's time for the Futures Free-for-All.
All right, everybody, welcome to the Futures Free-for-All. No shortage of ways for you folks to get at us, at options on most major social media platforms. Questions at theoptionsinsider.com also works, or of course, if you're hanging out in the live, your questions always get bumped to the top of the list. Let's see, we got a few flowing in here. Let's go first to a lot of talk about Ether in there. I get it. I'm with you. Let's go out to Frank first. Frank wants to know, is Carley bullish the equities market at these levels? And are you long right now? He wants to know, are you just selling puts to get long, or are you on the sideline? So Carley, let's start in the equities. Frank wants to know, you kind of talked about this a little bit already, but he wants to know specifically, are you riding this market up right now? Are you starting to sell some puts, maybe on the sidelines, a little cautious? He wants to know how you're approaching it.
So it's kind of a loaded question because it depends on if we're talking about like our speculation and option trades or my personal portfolio. In either situation, the big picture, I'm honestly, I'm not bullish, I'm not bearish for the short run. I'm just in a wait and see mode. I mean, this has been this is absurd, to be honest. I don't know how else to describe it. It's absurd. It's similar to a couple patterns I've seen before during the financial crisis, and then also like the 2023, 2022 bear market, where we had a big sell-off and a recovery that gets almost to the all-time highs and then rolls back over. And I think that's probably the most likely scenario, not because I'm pessimistic or I don't have faith in whatever's going on in Washington, D.C., although there's so many question marks who could possibly be, have any type of strong opinion either way on that. The reality is we're still working off all the excesses of the last 5 years. This is my opinion. I think there was so much manufactured prosperity built into the markets that even if everything goes perfectly and as well as planned with the rebalancing of the trade war or the trade structure, I still think we need to do a little more working off the excess. And if that's the case, we don't necessarily have to sell off and go retest the lows, but we probably need just some time to go by and some chop. So that's that's kind of where I'm at here. I wouldn't want to necessarily be short, wouldn't want to necessarily be long. It's just, all we can do is wait and see. For my personal portfolio, if we're talking like long-term investments, I came into the correction in a pretty good spot. I've been pretty open about that in the media. I was holding mostly treasuries, very few stocks or stock funds. But I'll be honest, like I tried to buy as much as I can on that dip, but it was so fast and so hard that I really didn't buy as much as I wanted to. So now I'm in a situation where I've learned my lesson on chasing prices higher. So I'm holding back my FOMO and I'm just waiting to see what happens. And I think that's probably what most people should do. Everybody wants to think that they have to do something today because the markets are moving, but markets are, they're always moving and prices are always temporary. It's generally a good idea to exercise patience and let things come to you as opposed to chasing prices. So that's my advice. Just try to let the market come back to you. If you want to be bullish and get more on, give it some time. The odds are probably going to get better opportunity to do that. If you want to be highly bearish and you're not in yet, thank goodness. And I'd probably be patient there. Who knows? This thing could drift up into the low 6,000. So we're kind of in no man's land here on a chart. So yeah, I wish I had some magic words or some crystal ball, but I don't. So
in your view, just given if past is prologue, it's most likely we drift higher, maybe retest some highs and then roll off that back to some more, maybe not quite lows, but back to some lower levels.
I think so. I mean, it wouldn't be, I'm old enough to remember we've had entire decades of the market not really going up or down, just basically trading sideways for a decade. And we're probably due for something like that. We've really had an amazing run since the financial crisis. It's been an awesome time to be an equity market investor. And kind of the last 5 years has kind of been a horrible time to be in bonds, but markets go in cycles. And, there's going to be periods where certain assets outperform others and vice versa. And I think we're probably in a period where, the stock market's probably had its time to shine. And we're probably looking at, maybe giving bonds that time here the next couple of years. So.
All right, next up, we've got a question from Mr. Unlimited. It's about your gold prediction, Carley, and what that means for silver. He wants to know, you predict gold at or below 2,000. He says, what does that do to silver? I know silver has been lagging gold, but what if the metals crash? Will silver not crash as hard? So silver's been a weird beast to watch of late. Obviously, nowhere near the rally in silver that we saw in gold. So he wants to know the flip side. If we see a massive crash in gold, do you think silver escapes, or is it going to be taken to the woodshed along with gold?
Okay, so there's two things that I'll mention there. First, I know it sounds completely insane to talk about 2000 gold, but we were just there a year ago. A year ago when we were on the way up, 2000 seemed expensive for a lot of people, and on the way down it's going to seem very, very cheap. But we've seen markets just recently. We saw the stock market give back over a year's worth of gains in a couple of weeks. So these types of things can and do happen, and I do think that's the most probable outcome. Now, when it comes to silver, the ratio between gold and silver is pretty lopsided. Gold is, as you mentioned, way overvalued relative to silver. Conventional wisdom, or at least my observation of that based on trading forums and other people I talk to, is most people are expecting silver to catch up with gold. But I actually think the opposite's probably going to happen. What I think is as gold comes down, silver also comes down, maybe not as much. So I think the ratio comes into line, but I don't think that ratio is going to come into line because silver's rallying and gold's selling off. I think they're actually both going to sell off. But silver will outperform on the downside, meaning it's not going to sell off as much. But I think silver could see the high teens again, 18, 19. I know nobody wants to hear that. Silver's really, really tough market. I mean, whether you're, maybe there's some people out there that are much smarter than me that have figured out how to make money there. But if you're a long-term investor, silver's been a money pit unless you bought the lows and just hung on for a very, very long time. And if you're an active trader, it's a really tough market as well, because the price action isn't smooth. It's very herky-jerky. It's a really tough market to trade. I think for the average person, I think there's opportunities in other markets that are a lot, there's no such thing as easy money or easy markets, but I think there's a lot easier than silver, I'll put it that way. But I do think silver probably makes its way down to $20 or probably a little below. Let's say $16 to $20.
All right, let's keep rolling here. Let's go out to this. I'll get out of here with this question from End User. He wants to know, so many minis and micros in the futures game. Do we expect even smaller contracts to come on the horizon? Well, we kind of already do have those. I guess if you extend the conversation, Carley, to these binaries that are out there, some of them very short term. Those are very bite-sized contracts. But maybe those aside, Carley, do you foresee even smaller contracts on the horizon?
That is a good question. I think it depends on the asset. So, for example, if we're talking about the stock indices behave differently than commodities. Commodities generally trade sideways in the big picture. Like, we have big rallies and big sell-offs, but they're not really going anywhere, which means you're probably never going to need a nano contract or whatever they might call it. I don't know what's smaller than a micro, whatever that would be. I'm going to call it a nano for this conversation. Commodities probably aren't going to need that because they're probably not going to get expensive enough to need that small of a contract. But the S&P might. When I got in this business, the S&P was somewhere around, I want to say 1,500. And so at that time we had a big S&P that was traded in the pit. Then we had an E-mini S&P, which is the same E-mini that we trade now. But back then the E-mini was kind of our micro. Like, it was a small contract because the S&P was trading at 1,500 and everything was on a small dollar value than it is with the S&P at 6,000. So if the S&P continue, with time, the S&P will eventually continue higher. Maybe it's not this month, but 5 years from now, we're probably going to be much higher than we are right now. And if that's the case, a nano contract or some sort of smaller contract would probably be appropriate. My question would be, would they actually, would we take off the mini like we did the original big and just rotate everything up? But I don't know. I guess we'll have to see.
Yeah, how weird would that be if the mini, which to me is still
was the big.
Yeah, the mini is still the new kid on the block, but now it's the big boy left on the block. If that became too big, Carley, and we had to kick that to the curb, then we're getting into some crazy territory. It doesn't seem like it was that long ago that the mini launched, Carley, and they had to limit how many you could do. I remember when I was trading SPX and you tried to hedge with the mini, they would limit you, I think, to 5 because they wanted to protect the big future. Those days seem so antiquated now in hindsight. So, yeah, if we're getting to the point where now the mini is too big, wow. Yeah. We're getting into some crazy territory.
Yeah, I think the mini margin was like 2 or 3 grand back then, and now it's like 24,000. So these are pretty wild numbers we're looking at.
Well, speaking of wild, Carley, if folks want to reach out to you about all these fun, wild predictions you've been making in the markets, or just in general have some thoughts about what they should be doing in these markets, and maybe they need a broker to hold their hand in these markets, that's, you guys are part psychologists at the end of the day, Carley. You got to talk them off the ledge sometime. You're like a bartender, only with their money rather than drinks. You got to hear all their woes, and certainly when they're up late at night in markets like this, you have to field those calls. So if folks want to reach out to you, Carley, where should they go? What should they do?
This is absolutely true. So we are a brokerage service. DeCarley Trading is our web address, DECARLEY Trading. And you can sign up for a free trial of our newsletters. You can, we'll fill you in on some of these strategies we're doing in our market analysis and all these crazy predictions and see how they pan out.
There you go. Check her out at DeCarley Trading, the place to go to kick the tires and light the fires. That is going to do it for us on the network today. Yet another quick plug for the brand new show hitting the network. If you're already subscribed to the full network, you don't need to do anything. You already have the European market brief in your ear holes ready to go. And if not, you should be listening to the full network. What are you doing? And then make sure you're checking out the pro, theoptionsinsider.com/pro, where it's a mountain, a literal metric ton. If you could weigh audio, it would weigh a ton, listeners, of content coming to you from the OIC conference. Look forward to that. Theoptionsinsider.com/pro gets first dibs. Back again tomorrow with our usual doubleheader of the option block and This Week in Futures Options, a show you should be listening to if you like this one. Then, of course, Friday Vol Views, and then one final time for our pro friends with some options oddities fun. Then we're back again next week, all the way through to next Wednesday, another episode of the Futures Rundown. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.